In today's segment, we'll begin with an expert's view on the US Federal Reserve's interest rate cuts. The US Federal Reserve has cut its key lending rate by 50 basis points. This is the first rate cut since the pandemic. The new rate is between 4.75% and 5%. The Fed plans to cut rates by another half point this year and 1 more percentage point in 2025. This rate cut might help the US economy grow and could affect how much people can borrow for things like houses and credit cards. Let's hear what our expert Animesh Hardia, SVP Quantitative Research at One Finance, has to say.
So generally speaking, the rate cut in the US is positive for the Indian economy. The point that needs to be clear here is global growth has been lagging for some time. However, when you look at India's fundamentals, the fundamentals are strong. Although there are pockets within the Indian economy which are lagging, like the rural consumption. However, the monsoon this year should be a positive. So the main crux of the advice that we are giving our clients at this point of time is focus on diversification. Interest rate cuts are a crucial time when there is usually a lot of volatility in the market, because we have to understand the drivers of why this is done. Firstly, this is usually done in response to slowdown in growth in the larger economies, or to evade recessionary fears. So what historically evidence has shown us is that the stock markets usually, especially the Indian stock markets, they see some volatility in the short term. They may go up, but as and when economic data gets released, especially leading indicators of the economy, if they show positive signs, then the stock markets perform well. So historical episodes have been followed by some volatility. But when you diversify into, let's say, debt investments, rate cuts and episodes of or phases of rate cuts are usually a good time, because there is that opposite correlation between the prices of debt products and the interest rates. So usually this phase is a good time to get into them. If you have loans outstanding, and loans are a crucial part of your financial journey, usually the more focus is on the stock market. Loans form a large part of the portfolio of an individual. So it's usually advised to move from fixed rate loans to a floating rate loan, mainly to benefit from further rate cuts. Given where the Indian economy is right now, real estate cycle has been picking up. In fact, it has been picking up post-pandemic. So with interest rates expected to go down, real estate is also a very good asset class to add to your portfolio.
Thank you for sharing your thoughts.